So every single analyst pretty much that we speak to, every investor says, yes, we are building up into a tech bubble. However, you do still want to be invested because these are the names that will continue to get runway when it comes to growth. So I'm wondering, for your mandate and the targets for your performances, how do you find opportunities when the prices are just so high at the moment?
Well, are the prices so high at the moment? I'm not in that, everything is extremely overvalued camp. And if you look at the broad spectrum of the markets, obviously tech's had a great run, but if you look at emerging markets, etc., they've had a terrible time of it. And obviously within the tech sector, you've got some stellar performers and some that are looking quite inflated. Having said that, you've got the stars, the stable stars, and they are just printing money at the moment, right? And so fundamentals, earnings are part of fundamentals, but the other part of fundamentals are discount rates. We discount earnings by an interest rate, and people seem to lose sight of that. They always go back to, can growth in earnings continue? Now, obviously, it can't keep on that trajectory, but we're looking at an extension of maybe another 5 years at least, but maybe another decade of financial repression where we're going to have zero rates for as long as the eyes can see. So we're discounting earnings by, close to zero rates. So I'm not seeing things as extremely overvalued at the moment, particularly with the tech giants.
Okay, so in terms of that traditional 60-40 balance you get in a portfolio, that's kind of been thrown out the window with the way that the bond market is trading at the moment, right? How do you, I'm wondering, manage or diversify or change the way to get those risk-adjusted returns in light of the extraordinary monetary policy, fiscal policy, and this just pandemic environment that we're in?
Yeah, look, 60-40 is your typical, I think, the American balanced fund. Australia, we tend to be closer to 70-30. So straight away, we're getting, more earnings yield from our equity portfolio and property portfolio itself. Within the defensive asset classes, the bonds, we look a little bit more towards taking a bit more credit risk on. And indeed, over the last few weeks, we've actually topped up our holdings in US high yield. So that's one of the ways that we're getting yield. The other thing, of course, is that we keep on having to educate our members that our expectations of future returns are also falling, right? So when we, 5-10 years ago, when we were constructing these the targets for these portfolios, we're looking at inflation plus 5 or even higher. A margin of 5% or more over inflation, and now that's gradually coming down to around 3.5%. So we are also lowering expectations.
And not to mention the fact that, as you can see in your investment portfolio on the screen right now, is Tesla, SolarEdge Technologies. We have seen this run-up in tech stocks, right? And we continue to talk about potentially valuations being pretty stretched. Where do you see them going this year?
Well, let's just to clarify, those companies are actually held in a very specialised investment option of ours. It's called in Global Environmental Opportunities. It's been an absolute stellar performer for us over the last few years, and Tesla is one of the pin-up childs of that portfolio. So it's fairly exceptional portfolio, that one. We don't actually hold much Tesla in our mainstream portfolios. In terms of that portfolio, do things look a bit stretched? Yeah, we've got, sort of broadly PEs of around, on average, around 45. So it's probably around 20 turns higher than the S&P average. Do we see value there? It's hard to see value in that portfolio. Does that mean that it's all about to collapse? No, it's, the tailwinds of... is creating some tailwinds from some very powerful thematics there. You've got the technology revolution combined with the green theme, and so that's lifting it. In terms of our more mainstream portfolios, look, we're still a big fan of the FANGs. They've had a pretty good run. They do look like they could do with a pullback right now, but whenever we've taken profits on our, we've always been overweight technology. And whenever we take profits on technology, we sort of sit at the edge of our seats, waiting for a pullback, ready to get back in. So we're we're likely to be a patient holder, expecting a bit of a pullback rather than a seller.
What about the downtrend of the US dollar that we've seen recently? How does that affect your views?
The US dollar, we're probably supporting our overweight Asia position. That's probably the best way of looking at a weaker US dollar. So we like Asia, we like China, and so we'll stay overweight there. We like India, obviously, though it's got to get through. This looks like it's doing it tougher than most countries in terms of dealing with COVID. But medium term, we do like Asia, and a weaker US dollar will support that position.
John, I want to get your views on this question, which is actually our MLive question of the day, which asks how gender equality influences assets and whether investors should be looking at gender representation and other inclusive factors when they look at across whole industries or certainly at individual companies. And of course, I ask this on a day when we have the first, woman of colour on a major presidential ticket as well. So how does that factor into your investment decisions? And is that a criteria that we should be looking more at?
Well, we don't single out gender equality. What we're looking for is diversification, full stop. Right? And obviously, gender is a key component of the diversification story. But we like to see a diversification of skills and gender and even race, etc. So it's not a gender-specific thing, although I do know that that's getting a lot more prominent, particularly in Australia.